Let's get across the market open now. David Lane joining us from Focus Partners Australia. David, welcome back to you. Good to see you in studio.
Thanks, Andrew.
Let's take a look at what's ahead for today. SPI futures indicating we are going to have a positive start. Interesting is what we saw on the market yesterday. In fact, it managed to just finish in the green. How would you sum up investor sentiment at the moment?
At the moment in Australia, I think it's relatively cautious. I think we've got the index itself hasn't moved a lot over the last month, but there has been a reasonable amount of volatility on individual stocks, and I think investors are a little bit cautious about what may be coming in to the August reporting season, some of the expectations that are coming there. And then when we look globally, we've seen that the US markets in general have still been relatively strong, although we've seen that sell off fairly significantly with the semiconductor type stocks and the concern about the hyperscalers maybe scaling down some of their expenses there. So yeah, a little bit of uncertainty around the world at the moment.
Yeah, this comes amidst US earnings season. We'll get to that in just a moment. You mentioned obviously a reporting season coming up here next month. What should we expect, do you think? And I guess, all eyes are going to be on guidance.
Well, yeah, I think guidance is very important. We've seen the last two reporting seasons as being the most volatile on record. I wouldn't be surprised if this one is just as volatile, if not more so. Guidance overall is actually relatively positive. So, consensus forecasts are for about 13% growth, although that's come back a little bit recently to about 11.9%. So analysts are starting to relook at their numbers. But what is interesting is that those consensus numbers hide the fact that we've got quite a big dispersion between analyst expectations. So I think over the next 2 or 3 weeks, we will see more changes to guidance, whether it's the companies come out and confess their sins early, or whether it's analysts making those adjustments. So I think that, we've seen the impact of rising interest rates, persistent inflation, higher cost of debt, all of those issues, as well as the hostilities in Iran and now the Red Sea, are all playing into expectations, and maybe that 11.9% is a little bit too optimistic coming into this reporting season.
Is that on the basis that we should expect a further slowdown in the Australian economy? And of course, on top of that, you've got what's going on in the property sector at the moment, so you have that negative wealth effect. So overall, that's a further dampening of consumer behaviour, isn't it?
I think that's certainly the case, yeah, and we've seen even the RBA has reduced their forecast for growth down from about 2.5% to 1.8, 1.7%. So I think a lot of analysts are anticipating that we are heading into a bit of a slowdown in growth. And as you said, the change in the property sector and investing in general, we've seen a lot of pushback from investors about the changes to CGT and the impacts that will have. So I think that has a bit of a dampening impact on business and business investment in general.
Well, let's turn to what we're seeing on Wall Street at the moment. Of course, we're well and truly into earnings season, just getting into some of those key mega cap tech stocks. The big question for investors is, in terms of the huge amounts of capex being spent, whether we're going to see returns there. Are we at that point where the winners and losers are emerging?
Not quite yet, but it's certainly a big question that we all need to be looking at. That there has been an enormous amount of capital spend, and forecasts are that will continue for quite a long time. That the hyperscalers are definitely adding a lot of capital into chips and into data centers and the infrastructure around that. So I think in the medium to longer term, we're still seeing a lot of tailwinds as far as that infrastructure build out is concerned. But as you said, it will be interesting over the next couple of years to see what that payback is going to be. And I think it's probably a little bit too early to start to see that. But the hyperscalers are still generating very, very strong earnings from their AI sales and also their software sales.
We have seen cracks emerge though, particularly in those chip stocks. Extreme volatility there now, because they're down about 20% off their highs in late June, so
yes,
technically in a bear market. Overnight, they jumped. Some of them are up more than 12 or 15%, in fact. So once again, is that investors just trying to get their heads around what's to come?
I think overnight it was a bit of bargain hunting and a bit of the speculative trade coming in. They've seen a lot of those stocks sold off fairly significantly. SpaceX and Nvidia did well overnight. So I think that's more of the short-term speculation and the fact that they're a lot cheaper than they were. We still have concerns about the valuations for a lot of those semiconductor and also the hyperscaler type of stocks, because they're very large businesses, very large as far as part of the index is concerned, and still trading fairly expensively at the moment.
Meanwhile, David, the Middle East conflict just drags on and on. In fact, it looks as though we've got a further escalation there, with the Yemen's Houthis now threatening to blockade another choke point for oil supply. Yet you look at the market reaction, it's been fairly muted, hasn't it? Oil has continued to move higher.
Yeah.
But then you look at the equity reaction and, well, they sort of shook it off.
Well, that seems to be the big scratching point, I suppose, as far as investors are concerned, is that the US market doesn't seem to be as concerned about what's happening over in Iran and now the Red Sea, as you said, as Australian investors are. We've sort of been very cautious and diverged from the US market. As you said, oil was stronger. We also saw the International Energy Agency come out last night talking about the strategic oil reserves and the fact that they've already released 290 million barrels, and that unless there's an opening of the Strait of Hormuz, they will need to tap into. They've got about $1 billion barrels in reserve still, but they will need to tap into that. The interesting flow-on effect from that report is actually that they've said that the Chinese demand for oil has actually declined 41% over the last 12 months. So we've seen supply constraints, but we've also seen a bit of a drop-off in demand. So it may not be as positive for the energy companies as we think that higher oil price will be.